Welcome back to Financial Freedom FX. In today's video, we are diving deep into one of the most reliable trading methods in Forex, the forecast continuation trading strategy. If you've ever felt lost trying to follow the trend or missed good entry points, this video is going to change that. You'll learn how to predict where price will continue, how to identify safe entry points, and how to avoid the most common traps that blow up trades. Let's begin. A continuation strategy is based on the principle that price trends tend to continue rather than reverse. It assumes that once a trend has formed, it's more likely to keep going in the same direction, unless major market signals suggest otherwise. The goal is to forecast where the next wave will begin after a pullback. You're not chasing the price. Instead, you're planning to enter during the pause, just before the next push. To use this strategy properly, you must understand three main concepts: structure, liquidity, and momentum. Structure helps you identify the trend. In an uptrend, you should see higher highs and higher lows. Liquidity is where the market hunts stop losses before resuming the trend. This often appears as a spike or wick in the opposite direction. Momentum is the force of the trend. Strong, aggressive candles after a pullback signal the return of buyers or sellers. Mastering these three concepts is key to predicting continuation points accurately. Let's go over the tools that make forecasting continuation effective. First, moving averages, like the 50 EMA and 200 EMA, show you the trend direction and act as dynamic support or resistance. Next, trend lines help visualize pullbacks and breakouts. The Fibonacci retracement tool highlights key zones, like the 50% or 61.8% levels, where pullbacks often end. Lastly, order blocks reveal areas where institutions previously moved the market. Combine these tools to create a high-probability forecast. Here's a step-by-step plan to forecast and enter a continuation trade. Step 1. Identify the dominant trend using market structure and EMAs. Step 2. Wait for a clean pullback. Price should move against the trend slightly. Step 3. Use tools like trend lines or fibs to mark possible reversal zones. Step 4. Wait for confirmation. This can be a bullish engulfing candle, rejection wick, or break of minor structure. Step 5. Enter the trade with your stop loss below or above the pullback and your target based on previous highs or lows. Never skip confirmation. Let's apply this strategy on a GBP/USD chart. First, identify the uptrend by spotting a series of higher highs and higher lows. Next, wait for a pullback. Price pulls back to the 50 EMA and aligns with the 61.8% Fibonacci level. An old bullish order block is also present in that area. Then, a bullish engulfing candle forms, rejecting the level. This is your confirmation. You place your buy, set the stop loss below the order block, and target the next swing high. This is how a textbook continuation forecast plays out. Now let's take a sell continuation example on EUR/USD. First, confirm the downtrend. Look for lower highs and lower lows. Price pulls back and taps into a bearish order block and also touches the 50 EMA from below. A strong bearish rejection candle forms at this level. You now have trend, structure, and confirmation aligned. The trade is entered with stop loss above the order block and take profit at the next low. That's a well-forecasted bearish continuation. Forecasting is powerful, but only when paired with proper risk management. Always use a stop loss below or above your structure. Aim for a risk-reward ratio of at least 1 to 2. Don't enter blindly. Wait for confirmation. Avoid emotional trading and don't move your stop loss once it's placed. Trading is a game of probability, not certainty. The goal is not to win every trade, but to win big when you're right and lose small when you're wrong. Stay disciplined. Sometimes even a perfect setup fails. That's normal. The market might break structure unexpectedly or react to unseen fundamental factors. When a forecasted continuation fails, review the setup. Was the trend weakening? Was there unexpected news? Did you force the entry without confirmation? Losing a trade doesn't mean the strategy is wrong. It's just feedback. Use it to improve your next forecast. Every failed trade sharpens your eye for better entries. One way to improve accuracy is by using multiple time frames. Let's say you're trading on the M15 or H1 chart. Before entering, check the H4 or daily time frame. Confirm that the higher time frame trend supports your forecast. Also use the higher time frame to locate major zones like support, resistance, or order blocks. When your lower time frame setup aligns with higher time frame analysis, it increases the probability of a successful continuation. Always zoom out before you zoom in. No matter how good your forecast looks, never ignore the economic calendar. High-impact news like NFP, CPI, or central bank decisions can override technical setups. If a continuation zone is forming right before news, wait. Let the news play out. Afterward, reassess structure. If the trend holds and a new confirmation appears, you can trade with confidence. Smart forecasting means blending technical analysis with fundamental awareness. Now, when is the best time to use the forecast continuation strategy? It works best during high liquidity sessions, especially the London and New York sessions. These periods offer strong moves and clearer trends. As for pairs, go for majors like GBP/USD, EUR/USD, USD/JPY, or commodities like gold XAU/USD. These pairs follow clean structures and give solid pullbacks. Avoid choppy or illiquid markets where trends are unclear. Before entering any trade, run through this smart forecast checklist. 1. Trend confirmed on higher time frame. 2. Pullback to key level or zone. 3. Confluence tools aligned, EMA, FIB, OB. 4th, confirmation candle formed. 5. No upcoming high-impact news. 6th entry, stop loss and take profit logically placed. If you've ticked all the boxes, you have a strong forecast trade setup. Let's summarize. The forecast continuation trading strategy helps you enter trends safely during pullbacks by combining structure, tools, and confirmation. You've learned how to identify the trend, wait for a retracement, confirm with tools, and enter with discipline. This strategy rewards patience, not FOMO. If this video helped you, smash the like button, subscribe to Financial Freedom FX, and comment "I forecast with confidence" below. Until next time, trade smart, trade safe, and stay consistent.